Welcome to the latest market overview, courtesy of Glyn Owens and James Clemster of Momentum Global Asset Management. This month, Glyn and James focus on the possible reasons behind the more subdued market returns of February, despite a strong start to the year in equities. As usual, if you'd like any further information or queries on their report, please use the Ask the Expert button to get in touch. Many thanks for your feedback and have a good month.
Glyn, the year 2013 started well with January providing decent equity market returns. How was February after that?
Yes, 2013 started very well. January was a big month, and that came on the back of several very good months in the latter half of 2012, of course. February was more subdued in markets, and I think there was a useful couple of reminders out there, Italian elections being one, a couple of things going on in the US, that actually the world still has some pretty serious problems that we'd alluded to in our last video recording. But intriguingly, although it was a more difficult month, in local currency terms, most equity markets were still up, particularly in the developed world. The US was up 1 or 2%, UK up a couple of percent. But actually, because the US dollar was strong, in dollar terms, the MSCI World Index of developed markets was basically flat for the month. In contrast, incidentally, emerging markets were down. And so far this year now, in these 2 months of this year, developed equity markets, MSCI World, is up about 5% or so, emerging markets flat. So there's quite an interesting contrast there.
That's good, thank you, Glyn. You mentioned a number of different events in the month we'll come on to in a minute, but just sticking with the markets for a moment, any big moves in the fixed income market that are worth noting?
Yes, well, I wouldn't quite describe February as a risk-off month, but because there were a few issues that, as I mentioned earlier, caused investors to step back a little bit and take stock, we did see safe haven government bonds performing better. So US Treasuries were up about 60 basis points in terms of return. Credit performed pretty much in line with that. Spreads were basically unchanged, so we got reasonable returns from high yield and investment grade credit, about the same as treasuries. But again, global government bonds, because of the impact of dollar strength, were actually down about 1% over the month. But it was definitely a period where there was a little bit more risk aversion. I'm not calling it a big risk off period, but more risk aversion than we've seen in several months.
Great, okay, let's turn to one of those causes of the risk aversion, the Italian elections.
Yes, well, that, I'm afraid, was a big disappointment. I think a lot of us had hoped that the Italians would be sensible in terms of reappointing a government that would continue with its austerity programme that's clearly been backed by the EU. In the event, some people describe Italy as ungovernable, of course, but in the event, we've got the worst possible outcome for markets. The lower house is now controlled by the centre-left. The Senate, the upper house, there is no party in overall control. Extraordinarily, a party led by a former comedian took a big share of the vote, and we now have a period where a government can't be formed at the moment. There is no agreement on a new government, so we really have a big problem in terms of uncertainty in Italy. And the issue is, I think, here, the Italian electorate has delivered a big blow to this whole EU austerity package. So I think that was an important reminder to investors that the problems in Europe have been reduced, particularly by the ECB's actions last year, but they've not been eliminated. But one final thing I would say on this, and we do have a period of uncertainty coming up as a result of those elections, one thing I would say is that on the day of the elections, when it was clear that we were going to get this worst possible outcome, we saw a big spike up in Italian bond yields. There was no real follow-through into the rest of peripheral Europe, and within a day or two the whole thing had sort of settled down a bit. And I think that's a very important point to note, that yes, there's been a problem in Italy, but a year ago that really could have been extremely destabilising for markets. Now we know the ECB is there as a backstop, and the rest of peripheral Europe actually was not hit by this at all. So I'm hoping that over the course of the next few weeks the Italians will be able to form a government without a new election. I think that's the most likely thing. There may be some easing off on the austerity, but there'll be a continuation of some of that programme. So I think it'll stay on track, but it's certainly been a bit of a wake-up call.
Yeah, okay. And while Italy disappointed recently, Japan, a serial disappointment for the markets, has actually providing some good headlines at the moment.
Well, fantastic headlines, yeah. I mean, Japanese market's up 30-odd% now from October, November time when Abe, even before he was elected, of course, the noises that he was making, it was clear that he was going to become leader and prime minister with the LDP winning this big majority. They've continued this very aggressive program to try and break out of this long deflationary spiral they've been in. And I think the important news this month is that Abe has now nominated Mr. Kuroda as the next governor of the Bank of Japan. That's got to be approved yet through various government committees, but it looks pretty likely he'll get in. And he is the most dovish of the candidates that were being considered. So I think we can be very confident that this really aggressive monetary easing that they're going to enter into is going to continue for quite a long time. Unlimited asset purchases, and we know a higher inflation target of 2%. So what has it done? Pushed the value of the yen down. The yen went down a little bit this month. The big falls were in the earlier months. It's fallen about 18% or so in 3 months. Hugely beneficial, of course, to corporate Japan, and we're already seeing profit forecasts being revised up in Japan. So, yeah, Japan was a good performer, the best performer in local currency terms in the month again. And I think there's probably more to go in the Japanese market over the next several months while this process, particularly a big monetary stimulus, gets underway.
Another currency that fell, of course, was sterling after the downgrade happened.
Yes.
Is that news or is that obvious, really?
Well, what you're referring to, of course, is the Moody's downgrade of government debt from a AAA status. The UK has lost its AAA status from Moody's, first time in whatever it is, 30 or 40 years. It was not a surprise to the markets. The downgrade came, we'd been warned about it. It came because of the weak growth in the UK and the difficulty, therefore, in paying down debt. It was really discounted in markets. There was not really even a wobble in markets. Sterling had been weak prior to that. It was certainly weak in the month, but most of that had occurred prior to then. It's down actually 4.5% against the dollar in the month, down about 7% so far this year. Funnily enough, of course, that's actually quite positive for the UK economy. But it's certainly raised a few alarm bells about where the UK is going. We're struggling with growth here, we know that. The government has reaffirmed its commitment to the austerity programme, but in a sense the UK is between a rock and a hard place. If it gives up on that, then it's going to have a problem with its debt levels, certainly have a problem with the ratings agencies and the further downgrading of debt if it does that. But of course it means a long period of pretty sluggish growth. And in many ways the UK is a very good barometer for the rest of the world. It's what the developed world is having to face generally.
Elsewhere in the developed world, data from the US, mixed but not too bad again.
Yeah, not too bad. In fact, the data from the US has generally been quite positive. They revised up Q4 2012 GDP. The initial estimate was for a small decline in GDP. That's actually came out with a 0.1 increase. It's marginal, but it's nevertheless still a positive. The news on the housing market remains good. We've talked about that before. That's a very, very important component of the economy, of course, not because it's size necessarily, because it's the impact on bank balance sheets, on people's confidence and wealth. And in fact, the strength in the economy was giving rise to some of the people on the Fed committee that sets monetary policy talking about tapering off the quantitative easing program, the asset purchase programs. So the US economy is in not bad shape. That tapering off of QE, incidentally, Bernanke, at a testimony to the Senate Open Market Committee, he basically said that QE is effectively working, it's not causing inflationary problems. He actually supported it very robustly, so I think we can be very confident there is not going to be tapering of QE in the course of this year. These huge asset purchases are going to continue. But the US has just tripped a little bit, of course. Here we are, March the 1st. The sequester, the automatic spending cuts did take effect today. That means $85 billion of automatic spending cuts this year. That's about 0.5% of GDP. So it's a headwind to growth. We know about that. We've always built it into our forecast, and it looks as if the private sector will offset that. But it means the US will still be in a relatively subdued growth environment, still in better shape than most of the developed world.
Okay, thanks, Lynn. Moving on to looking forwards, really. In the last couple of months, there's been a lot of talk about the Great Rotation and the return of animal spirits, if you like. We've sounded a more cautious note today. do we expect further consolidation over the next coming?
Yeah,
next few months?
I think it's likely we will see a bit more consolidation. We must bear in mind that since the middle of last year, particularly since Draghi's famous "we'll do whatever it takes" speech, markets are up 25% or so. Having said that, valuations are still pretty reasonable. So I think there's room for some consolidation here, and I think we will get that because of these little uncertainties that have crept in, little reminders that there are some difficulties out there. There's still issues about growth. We know we're in a low growth environment for some time to come. But underpinning this, you've got decent valuations, corporate sector in good shape, and I'll re-emphasise that because the corporate earnings season this time round has been good. We've had really good results coming out. So, yeah, I think we are in a bit of a consolidation phase. I don't think it's a big risk-off phase where we're going to get a big drop back in markets that we were seeing, let's say, in the second quarter of last year. But I do think later this year markets will actually pick up again. We'll see good returns from equity markets.